All right, buckle up because today we're going deep into the world of wealth management. We're talking about how the ultra-wealthy make their money work for them. Not just for them, but for generations to come.
It really is fascinating. It's more than just a high net worth. It's about a legacy of financial security, and one that lasts far beyond their lifetime.
Exactly. You know I love a good treasure map, and this document you gave me pasted text. It feels like we're cracking the code of financial dynasties.
I think there will be some surprises in store. The first thing that jumped out at me is their mindset. It's less about quick wins and more about the long game. They're thinking 5, 10, even 20 moves ahead.
So no get-rich-quick schemes. These folks are playing a different game. It's all about wealth preservation.
Absolutely. Wealth preservation is the foundation. They want their money to not just last, but to thrive through good times and bad. And their approach to risk is really interesting. It's not about avoiding risk. It's about being aware of it.
So they're not stuffing cash in the mattress. They're putting it to work strategically. They know there are risks, but are navigating them carefully.
Exactly. They understand that calculated risks are essential. They don't avoid risk, they assess it, looking for potential downsides and mitigating them.
Now, this is where I get excited. Asset allocation. This document makes it clear that the wealthy aren't just buying stocks and bonds. They're diversifying with real estate, private equity. It's like a financial fortress with multiple layers of protection.
Perfect analogy. Diversification is key. Spreading wealth across different asset classes, knowing that each reacts differently to economic conditions. It's don't put your eggs in one basket, but on a whole new level.
Okay, let's unpack some of that. Let's start with real estate. The document covers luxury homes to commercial properties to REITs.
Real estate is attractive for a few reasons. First, it's a tangible asset. You can see it and touch it. That's a level of security some investors really like.
Yeah, it's not just numbers on a screen. It's a real piece of the world.
Exactly. And then there's the potential for appreciation. Historically, real estate values go up over time. Obviously, location and market conditions impact this. But importantly, it's a hedge against inflation.
You know, I hear that phrase a lot, but I'm not sure I fully understand it. How does real estate hedge against inflation?
Well, when inflation rises, the cost of everything goes up, right? That includes construction materials and labor. That means the value of existing real estate tends to rise too, keeping pace with those increasing costs.
Ah, I see. So owning a vacation home could be a smart financial move.
It could be. Real estate still has risks like any investment. It's not just about emotional appeal. It needs to be a strategic decision based on location and market trends.
Makes sense. Now we have to talk about the stock market. When people think of investing, they picture the stock market. And the document talks about how the wealthy use a combination of stocks, ETFs, and mutual funds.
They use both active and passive strategies in the stock market. Active investing means lots of research and analysis, often using sophisticated tools and models to find undervalued stocks. They really dive deep into a company's financials, or use quantitative algorithms to guide their decisions.
So it's way more than picking a company you like or heard a tip about.
For sure. Then there's passive investing, where they might buy index funds or ETFs to track a market or sector. That offers broad exposure and usually lower fees in management.
So it sounds like they carefully balance these strategies based on their goals and risk appetite.
Exactly. And this is really just the beginning. There's a whole world of strategies they use, from fundamental analysis to technical analysis to value and growth investing. It's fascinating to look at their thought processes.
I'm definitely hooked. But before we go too far, let's talk about bonds. The document calls them the steady eddy of a portfolio. Are they really that important for high net worth individuals?
They absolutely are. Bonds are critical for generating consistent income and for balancing out the volatility of stocks. They tend to be less risky than stocks, especially government bonds. Corporate bonds can offer higher returns, but those come with more risk. And then there are municipal bonds, which can have tax advantages.
So it's about creating a well-balanced meal. Stocks are the protein for growth. Bonds are the carbs for steady energy. And maybe alternative investments are a bit of spice.
Love the analogy. It really does capture the essence of asset allocation. You need a mix of assets that work together to reach your goals.
Speaking of spice, the document mentions alternative investments.
Yeah.
Private equity, hedge funds, commodities. Those sound a little mysterious, maybe even intimidating.
They are more complex and often carry higher risks, but they can also offer opportunities you won't find in traditional markets.
So not for the casual investor, but potentially rewarding if you know what you're doing.
That's right. They require a lot of knowledge and experience. You really have to understand the risks involved.
Okay, before we move on, I have to ask about cash. We always hear cash is king, but it sounds like even the ultra-wealthy know it's not everything.
You're right, cash is important, but it's more about liquidity and flexibility than being king. Even for the very rich, cash lets them take advantage of opportunities. A sudden market drop or a great property becomes available, or maybe a new venture needs funding.
So it's about being ready to act when the time is right.
Exactly. The document highlights how they keep their cash working: high-yield savings accounts and money market funds, or certificates of deposit, all while keeping it accessible.
This is fascinating. I'm seeing how all these pieces of the wealth management puzzle fit together.
And we've only just scratched the surface. There's still so much to uncover.
I think we need to pause here and absorb this. We'll be back soon to explore how the wealthy plan for the future. We'll look at retirement accounts to tangible assets and even cryptocurrency.
Welcome back. Are you ready for more? We're going to explore how the ultra-wealthy approach long-term planning. Trust me, it's a lot more than a basic 401k.
You've got me curious. We've talked about their mindset, their approach to risk and diversification, but I want to know how that translates into real strategies for the future.
Okay, let's start with something you might not expect: retirement accounts. You might think those wouldn't be important for millionaires, but the document shows they understand the importance of planning for their later years, even with significant wealth.
So 401ks, IRAs, those aren't just for us regular people.
Not at all. They offer tax advantages and the potential for long-term tax-sheltered growth. Those benefits are valuable no matter your income level.
That makes sense. It's about taking every advantage even when you're already wealthy.
Right. But it goes beyond that. The document also shows how they use tangible assets as part of their long-term strategy. Things like art, antiques, precious metals, even classic cars.
Wait, are we talking investments or a heist movie?
Maybe a bit of both. These tangible treasures have two purposes. They can be passion investments, indulging interests while potentially seeing those assets appreciate.
Combining a love of art or classic cars with financial strategy. Sounds like a good deal.
It can be. But there's another layer. Tangible assets can provide stability and security, especially during economic uncertainty. They're physical objects you can hold, touch, and even display, which can be comforting for some.
It's like a tangible representation of your wealth. Okay, I can't wait any longer. We have to talk about cryptocurrency. Is this just a fad, or are the ultra-wealthy taking it seriously?
It is a volatile market, there's no question, but there is the potential for big returns. And the document stresses understanding blockchain technology.
That's where I get lost. Can you explain blockchain in a way anyone can understand?
Think of it as a digital ledger, recording transactions across tons of computers that makes it incredibly secure and transparent. That's the core of blockchain. It could revolutionize not just finance, but things like supply chains, healthcare, even voting. There's so many possibilities.
So it's not just about the price of Bitcoin. It's a whole new way of thinking about trust and value in the digital world.
You got it. And I think that's what's drawing some wealthy individuals to crypto. They see it as a disruptive force, a potential game changer, and they want to be involved.
I'm starting to see it. Now let's talk about something I find really admirable: philanthropy and impact investing. The document shows how many wealthy individuals see their wealth as a way to make a positive impact.
It's a core part of their wealth management philosophy. They know that great wealth comes with responsibility, and they want to use their resources to tackle big problems and make a difference.
It's not just about having more. It's about giving back.
Yes. And there are many ways they can do this: charitable donations, foundations, impact investing. That means investing in companies and projects that generate financial returns. And also positive social or environmental impact.
So you're aligning financial goals with values, making money work for good.
That's the idea.
Yeah.
And now, a less glamorous but equally important topic:
Taxes.
taxes, the one certainty for us all. I imagine it gets even more complicated with a lot of wealth. Absolutely. Taxes are a key consideration for the ultra-wealthy. The document explains how they use tax-advantaged accounts and strategies to minimize their tax burden legally and ethically.
So things like HSAs, 529 plans, FSAs, those aren't just for the average person.
Anyone can use them, but the wealthy use them more strategically. They work with advisors to navigate the tax code, to make sure they're maximizing deductions and credits.
Sounds like tax planning is an art in itself.
It can be. You need to understand the tax laws, which are always changing.
Now, for something I'd never heard of before, family offices. The document calls them the ultimate wealth management tool, but I have no idea what that means.
Imagine a private company dedicated to managing the finances of a wealthy family. That's a family office. They handle everything: investments, estate planning, philanthropy, taxes, even concierge-type services.
So it's like a team of experts at your disposal, focused on protecting and growing your wealth.
Exactly. They have a diverse team of professionals, financial advisors, lawyers, accountants, investment managers, even lifestyle managers.
It's like a financial control center for a whole dynasty.
It is, and it lets the family focus on their own passions and businesses, knowing their wealth is in good hands.
That's impressive. Okay, let's shift gears and talk about international investments. The document suggests the wealthy aren't just focused on the U.S. They're looking globally to diversify and capture growth opportunities.
Globalization has opened up a lot of possibilities, and the wealthy are leading the way. They're investing in emerging markets, new industries, and taking advantage of currency fluctuations and global trends.
So it's not just about the American stock market anymore.
Nope. The world is open to them.
But international investments come with their own challenges, right?
Of course. Currency fluctuations, political issues, different regulations. It's complicated. That's why they often work with advisors specializing in international markets to help them make smart choices.
It's a balance of opportunity and risk.
For sure. Which brings us to another important part of wealth management: risk management.
Right, because even with a team of experts, things can still go wrong.
Definitely. The document highlights some key strategies for reducing risk. Things like insurance, diversification, and having a plan for economic downturns.
So it's not just about making money. It's about keeping it safe.
Exactly. Insurance is a big part of that. They'll have insurance for their homes, businesses, art collections, yachts, anything you can think of. Protecting their assets from the unexpected.
And we've discussed diversification, but it's worth repeating. Spreading your wealth across different asset classes, regions, even investment styles, that's crucial for managing risk.
It is. It's that old saying about not putting all your eggs in one basket. If one area of your portfolio suffers, the others can help soften the impact.
Now, what about preparing for economic downturns? Those seem impossible to predict.
They're tough.
Yeah.
But the ultra-wealthy work with advisors to develop strategies to weather those storms. They might have large cash reserves, increase their bond holdings, or even invest in sectors that do well during recessions, like healthcare or consumer goods.
So always have a backup plan.
You got it. And that leads us to the final piece, the power of expert advice.
Let's talk about that, because we've seen how smart and strategic these individuals are. But the document shows they still rely on advisors.
They do. Managing wealth, especially at that level, is incredibly complicated. There are so many things to consider, so many areas of expertise. No one can be an expert at everything.
So it's like a personal trainer for your finances.
Perfect analogy. The document emphasizes finding the right advisor, someone who understands your goals, your values, your risk tolerance, someone you trust completely.
So it's a real partnership.
It is. And before we finish this section, I want to touch on one more thing. The importance of ongoing financial education.
I like that. Wealth management isn't about being born rich. It's about constantly learning and growing.
Absolutely. Wealthy people are often lifelong learners. They understand that the financial world is always changing, and they need to stay ahead of the curve. They read, they go to conferences, they talk to experts. They always want more knowledge.
So it's not just about the money. It's about the knowledge to use it wisely.
Exactly. And that's a message for everyone, regardless of where you are financially.
Well said. I'm full of new insights. We've covered so much, but I can't wait to hear your final thoughts.
Let's take a moment to digest everything. When we come back, we'll break it all down. We'll look at the most valuable lessons and see how you can apply them to your own finances, wherever you're starting from.
That was quite the journey. We really explored the world of wealth management, uncovering the secrets of the ultra-wealthy. My mind is still buzzing with all this information.
It was a deep dive, for sure. We covered so much, from asset allocation to risk management, even philanthropy and the power of expert guidance.
You know what struck me most? It's not just about the amount of money you have. It's about how you approach managing your finances. That's important no matter where you're starting from.
I agree. A lot of these principles can apply to everyone, whether you're just beginning to build wealth or you're already well on your way. Having the right mindset and smart strategies can make a big difference.
So it's about taking those lessons from the ultra-wealthy and figuring out how to use them ourselves.
Exactly. Understand why they do what they do, and then find ways to apply those same ideas to your own financial life.
Now, before we wrap up, I want to leave our listener with something they can use, a key takeaway to put into practice.
Of everything we talked about today, what stood out to you the most? What made you think differently about your own finances?
I think for me it was diversification. It just makes so much sense. Spread your investments across different areas, asset classes, sectors, even different parts of the world, to reduce risk and maybe even get better returns.
That's a great choice. Diversification is really important for financial planning.
And it doesn't have to be overly complicated. Even small steps can help. Maybe adding a new type of asset to your portfolio, or rebalancing your existing investments. Those little changes can have a positive impact over time.
Definitely. It's about taking control and making sure your finances are solid.
So to our listeners out there, I encourage you to learn more about diversification. Research different asset classes. Think about your risk tolerance. Maybe talk to a financial advisor to get some personalized advice.
And remember, building wealth is a marathon, not a sprint. It takes patience, discipline, and a commitment to always learning.
So true. We've seen how the ultra-wealthy never stop learning. They're always adapting to the changing financial world. We can all benefit from that same attitude.
Absolutely. Stay curious, stay informed, keep looking for new ways to grow and protect your wealth.
Well, that brings us to the end of our deep dive into wealth management. I hope you've all gained some valuable insights and some practical strategies to help you on your own financial journey.
It's been great sharing this with you. Remember, building a secure and prosperous future is possible. Start by taking a small step today and watch how it grows over time.
Thanks for joining us. Until next time, keep learning, keep growing, and keep striving to reach your financial goals.